So, okay, so what are the things that, that kind of this research has been about? Well, in this paper, the first thing we do is kind of introduce this measure that I just showed you, that we label active share. That's kind of a new and intuitive measure of active management. But then we also want to take this measure to the data, and we want to see exactly how much active management, what type of active management there is in our sample. And our sample is U.S. mutual funds. I mean, that's the sample that we have easy access to in terms of data. So that's the sample that we work with. So what we do is we look at the cross-section of mutual funds. So here we want to see things like how is active management related to, for example, fund fees? How is it related to manager tenure? How is it related to fund size? And that kind of things. So we want to kind of understand the cross-section of funds, but we also want to look at the time series of funds. So over time, are there any trends in active management? I mean, for example, perhaps closet indexing has been more of an issue recently than what it was in the past. That's something that we'll be able to answer with our data as well. And then finally, we also want to look at fund performance, how active management is related to fund performance. And to give you a brief preview of what we find here is we kind of look at both, when we look at performance before fees and expenses, which gives us an indication of whether managers have ability in selecting stocks and kind of deviating from the index. We do find evidence that managers, that especially the most active managers have ability and they are adding value. So that's before fees. But what about after fees? So as an investor, what you really care about is your after fee, after transaction cost performance. So what is the record after fees? Well, we still find that even after fees, the most active fund managers have added value, have actually beaten their benchmarks. So that's somewhat reassuring for investors who are kind of looking for actively managed funds. So I've talked about active management a little bit, but at this point you may be thinking that there are already measures of active management. So in particular, tracking error is the most common measure that people have used in the past. So how is active share related to the tracking error of a fund? Well, to answer that question, let me go back to this decomposition, where I decompose the portfolio into the benchmark index plus the deviations from that index. So I looked at this composition in terms of holdings, but we can also look at it in terms of returns. So the return on the portfolio is going to be equal to the return on the benchmark index plus the return on the active long-short positions that a fund has. So then how is tracking error defined? Well, tracking error volatility, or also known as tracking error, that is defined as the standard deviation of the return on those active long-short positions. Okay, so that's the usual definition. So we've got now we've got two measures of active management. We've got active share, which is based on the size of the active positions relative to the index, and we also have the tracking error, which is based on the time series volatility of the return on those active positions. Okay, so we got these two measures. Now, which one of these two measures, can we just use one or the other? Well, actually, it turns out that we need both. Okay, we need both measures of active management because they capture somewhat different aspects of active management. So let me just illustrate that right now. So as an example, let's think about a fund that has 100 stocks. So the point here is it's a fund that's potentially well diversified. So how active management shows up in this kind of a portfolio, that depends crucially on whether the portfolio positions are exposed to systematic risk. Okay, how your active positions in particular are exposed to systematic risk. So if, for example, for a fund, if all of the stocks where a fund is overweight relative to the index, if all of those stocks are technology stocks, and we know that technology stocks tend to move together, that's going to generate relatively high tracking error even when the active positions themselves are relatively small. Now, alternatively, you can also even with relatively big active positions, you can generate relatively little tracking error volatility if you don't have exposure to systematic risk. So for example, let's say there are 50 industries out there in the US market and let's say 20 stocks within each industry. So what a fund can do is a fund can pick, let's say, one stock out of 20 in each industry. Okay? So you're picking just one stock out of 20, so you're very selective within industries. But if you keep the same industry weights as the benchmark index, then you're not exposed to any kind of systematic industry risk. Okay? And that would allow you to have relatively low tracking error because the only risk that you're bearing relative to the index is going to be stock specific. Okay? And that stock specific or idiosyncratic risk, that's something that can be largely diversified away. Okay? So it really depends on what type of an active manager is. Where is it that you think you're adding value in terms of stock picking or taking positions on systematic kind of sector risk or let's say value versus growth exposures or that kind of things. So just to kind of illustrate that a little bit further, let's put on the x-axis we've got tracking error, on the y-axis we have active share. And we got these two measures of active management. If we think about the benchmark index, such as the S&P 500, that's going to have 0 tracking error and 0 active share, okay, with itself. But now, as an active manager, let's say we start kind of adding positions. We start adding on top. We start with the index, but we start adding positions that have exposure to systematic risk. Then we're going to be moving along this line right here. So we're going to have some active share, but it's relatively little active share, and even then it's going to generate high tracking error because we're exposed to systematic risk. Okay? So that's the first type of approach here as for an active manager. The second approach is you start with the index, but you start adding these diversified bets or idiosyncratic bets on individual stocks. So kind of a more traditional stock picker that kind of is still relatively well diversified. So once you add these kind of diversified stock picks to your portfolio with high active share, you actually don't generate much tracking error. So if we just use tracking error to measure active management, which is what people have done for years, they would basically overstate the active management of these guys who are taking kind of systematic factor bets. And tracking error also understates the active management of these diversified stock pickers. I mean, these diversified stock pickers might look like closet indexers because they have kind of relatively low tracking error. But at the same time, the diversified stock pickers can actually be adding significant value. I mean, if they're doing a lot of stock selection, and that can be the source of abnormal return relative to the index. So it's really key to be able to distinguish these guys from the closet indexers. And especially the tables that I'll show you later will kind of highlight that a little bit further. So just to kind of, I talked about the couple of labels here. So tracking error and active share. I talked about the factor bets and the diversified stock pick labels. Of course, a fund can do both. A fund can both kind of select individual securities as well as kind of take bets, sector bets, relative to the benchmark index. In that case, we could call it a concentrated stock picker. And if you don't do anything relative to the index, that's of course pure indexing. But if you're a little bit different from the index, but you're kind of claiming to be very much an active manager, and you're charging fees for active management, that would put you in the closet indexing category. Okay, and there's certainly a good number of funds in each of these categories. So just to give you some recent examples, Vanguard 500 is probably it's a kind of a traditionally been the biggest fund in the indexing category. Fidelity Spartan Fund also has actually even slightly lower tracking error and active share than Vanguard, so it's even kind of slightly more closely tracks the index. T. Rowe Price Mid-Cap Value, that's one example of a fund that kind of intentionally wants to be very diversified in terms of industries, but it's actually making active stock picks within those industries. Here's a fund. Actually, this is an older fund. That one fund is actually not from '09. But this is, I just haven't had time to update this fund yet, but But basically, this fund used to be kind of someone, I mean, they used to actually give you these long descriptions in their prospectus about how they take sector bets relative to the index. So they're really timing different sectors of the economy, and they had this sector rotation approach, which is how they thought that they were adding value. And that put them in the factor bet category. Longleaf Partners funds, that's a very focused stock picker. They only have 17 stock positions at the end of last year. So they're kind of taking pretty concentrated positions there. And then in terms of the closet indexing group, we have one of the worst examples at the end of last year was Janus Intech Growth Fund. Active share about 30%, tracking error 2.5%. So, you know, it's kind of hard to see how they were kind of adding much value relative to the index, especially after fees. Now, okay, so those are kind of some of the different types of fund types. Now, when we quantify active management, what I would advocate is that you use both active share and tracking error to get a more complete picture. In some cases, if you just use active share, it has a couple of benefits. And those benefits include, you know, it's a very simple number. You know, it gives you the percentage that's different from the benchmark index. So if you say my active share is 60%, everyone kind of understands that that's how your portfolio is different from the index. You know, 60% of your portfolio is different from the index. It's a very easy number to interpret. Secondly, you don't actually have to estimate it. So you can actually just compute it whenever a fund discloses its positions. So compared to, for example, tracking error, I mean, you actually have, you know, you need past data to estimate it. But with active share, all you have to do is once you see the disclosed portfolio holdings, which in the US have to be disclosed every quarter, and then you can just compute it without any error whatsoever. And another benefit of that is, for example, if a fund's active share changes dramatically from one quarter to the next, you can capture that fully. So this in particular kind of lends itself to some nice case studies. Actually, one fund that I've kind of looked at in the past is Fidelity Magellan. It came under, obviously, the fund has a spectacular past with Peter Lynch. At some point, it actually came under pretty heavy criticism for kind of, with another manager, Bob Stansky, for not being very much different from the index. But then in 2005, they changed managers again. And then it was kind of interesting. If you look at the active share data for Magellan, what you see is that when Stansky left and the new manager, Harry Lang, took over the fund, it dramatically increased the active share of the fund. From about 35–40%, active share jumped to about 70% in just one quarter, okay? From the end of September to the end of December. So it's a really like several standard deviation jump. So you clearly see these kind of policy changes in how the fund is managed. So, so those are some of the benefits of using that measure. Now, okay, now at this point, these are kind of nice concepts if we want to understand what the fund managers are doing. But as investors, do we really have to care about this? As investors, do we really kind of have to understand exactly the active management process and these types of active management? Well, the answer is we actually do have to care about this even as investors, because either measure, tracking error or active share, could predict fund performance. So, and that's the bottom line investors obviously care about. So, and ex ante, we really don't know how active management is related, how different types of active management are related to fund performance. So, so that's kind of a purely empirical question that we actually undertake in this study. What we find in our study is that active share tends to be that's the measure that actually predicts fund performance. In other words, the funds that have high active share are the ones that outperform, which kind of indicates that stock picking is the dimension that's rewarded in the marketplace. Stock picking is the dimension where managers actually have been able to add value in the past, even net of fees. And but if you look at tracking error does not predict fund performance. So that tells us that the managers that are just primarily taking factor bets on various sectors or trying to time the market, those are the ones that are actually not earning their fees. So those are the ones that you should stay away from. So, and I'll show you kind of more numbers on that, but that's kind of the preview. So now let me give you a few more details on how the study was conducted before I actually get to the numbers. Yeah?
What about the concentrated stock picks?
Concentrated stock picks, I'm going to show you the numbers category by category. It actually, so that could go either way because you're kind of have both high active share and high tracking error. It turns out that if you take the whole history for the last 20 years, concentrated stock pickers actually have not performed very well. So it turns out that it turns out that it's really the diversified stock pickers that have added most of the value. So that's actually something that's kind of changed a little bit over the last few years. I mean, it used to be that, concentrated stock pickers kind of have been a very, it's a very volatile category. So some years they're kind of up dramatically, and other years they're down dramatically. And in the last few years, they have actually not done so well. But I'll show you the numbers so we can talk about it in more detail. Okay, so the data sources, well, we've got our pretty much standard kind of academic data sources based on disclosed portfolio holdings. Those are required by the SEC in the US, the US main regulator. So all the funds kind of have to disclose them every quarter. The main things that we kind of do that other people don't do in the literature are we have data on fund holdings and the benchmark index holdings. So we obviously need those two to be able to compute active share based on the positions. And then secondly, we have daily fund returns. This is because we want to estimate tracking error very accurately. And the best way to estimate tracking error is from daily data, not from monthly data. Monthly data is pretty noisy. It gives you kind of pretty inaccurate estimates. But other than that, it's similar to what other people have done in the literature. Now, so what does our sample look like? Well, what we do is we want to pick mutual funds that are all equity. Okay, so all equity US mutual funds, which basically means we're excluding balanced funds, asset allocation funds, precious metal funds. We also want to exclude sector funds because simply we don't have good benchmark indices for sector funds. Okay, so we want to use the ones that have diversified benchmarks such as the S&P 500, Russell 2000, and so on. The final sample, about 2,700 funds over a 30-year time period. So that's kind of what we're working with. What are the benchmark indices that we're comparing these funds' performance to? Well, we have indices from 3 providers: S&P, Dow Jones, Wilshire, and Russell. So the indices first, if you look, the index that covers the entire market in the US is the Dow Jones Wilshire 5000. Actually, they were split last year, so now there's kind of 2 separate indices, the Wilshire 5000 and Dow Jones Total Stock Market. The indices are identical, though. But anyway, so that covers the entire market. You can split it into the S&P 500, which is large caps, and the Wilshire 4500, which is mid caps and small caps, or everything else, in other words. S&P 500, furthermore, you can split it into value and growth styles, or you can look at the mid cap and small cap S&P indices, the S&P 400 or 600. And then we also have indices from Russell. The Russell 1000 covers the biggest 1,000 stocks in the US, so large and mid caps. And then Russell 2000 covers the small caps and is the most prominent small cap index. Russell 3000 covers both of those universes, top 3,000 stocks. Mid cap is the bottom 800 of the Russell 1000. And then we have value and growth components of each as well. So it's a pretty good selection of indices, pretty much all of the top indices, all of the popular indices that US funds are benchmarked to. So how do we then assign, when we look at fund performance, how do we assign a benchmark index to a fund? Well, what we do is, in the latest version, we actually have data on the self-reported benchmark indices of funds. So this is based on the benchmark index that funds report in their prospectuses. We've got 2 snapshots of time at the beginning of 2007 and at the beginning of this year. If we cannot find data for that, then we're going to choose that benchmark index that gives the lowest active share to that fund. In other words, that benchmark index which has the greatest overlap in terms of holdings with that fund. And we actually take the last 3 years just to kind of see the one that kind of has been consistently similar to the fund style. So that's kind of the benchmark index selection. All right, so let me then get to the numbers. If we look at, so these numbers are now based on they're kind of similar to what you had before, or what you have in the handout, but anyway, this is based on 09 numbers, so there's going to be some differences. If you look at first of all, the distribution of funds across these two dimensions, here we have active share groups going from 0 to 10%, 10 to 20%, all the way to 90 to 100%. And then we have tracking error groups, 0 to 2% tracking error volatility per year, all the way to greater than 14% tracking error volatility per year. Okay, and each number here represents the number of funds in that cell. So for example, this number here says that there's 21 funds with an active share between 90 and 100%, tracking error 4 to 6%. So the first thing to note here is, if we look at this distribution of funds, it's kind of you basically have this two-dimensional distribution. So, there's clearly kind of big dispersion along both dimensions. So for example, within a given tracking error group, you still have a lot of variation in active share. So if your tracking error is 4 to 6%, your active share could still be anywhere from 30-something% to close to 100%. So a lot of variation is possible within that group. Similarly, if you pick the active share group 70 to 80%, your tracking error could be as low as somewhere between 2 and 4%, or it could even be greater than 14%. So the point is, there really is kind of, it's not just like one line when you plot these two things. You really have these kind of two different dimensions along which you can find funds.